Welcome to another edition of Inside the Economy. I'm Brian Gieman. Thanks for joining me. Today we are going to discuss U.S. inflation and disposable income, stock market earnings and volatility, and wrap up with updates on the U.S. housing market. As we turn to the economic report, we received new unemployment data this last week, indicating that the unemployment rate ticked down to 4.4%, continues to hover near this multi-decade low. We have seen the crude market hover in close to the $60 per barrel range for the last couple of weeks now, especially after the large news coming out of Venezuela to begin the year. On the interest rate side, not a ton of adjustments. The 3-year T-bill all the way through the 30-year bond are all relatively in the same zone that they were going back just the last couple of months, so not much to speak of for the broader interest rate world. We have seen a tick down in the 30-year mortgage, close to the 6% mark, so perhaps a little relief on the way for the home buyers out there, and more to talk about later in the presentation. Also of particular note, the broader economic data, the ISM manufacturing or the ISM service, GDP, and key inflation metrics were all delayed coming out of the government shutdown in late 2025. So it'll be great to have updated data and information that we look forward to presenting in the future. Underlying U.S. inflation was tame to close 2025. New data from about a week ago indicated that the inflationary rate was less than expected for the month of December, which was great news. As we can see on the bottom half of this chart, the change in core consumer price indexes continuing to hover right around this 2.5% level or so for the last chunk of time. What's really fascinating is now that we do have the government shutdown behind us and we'll continue to receive more consistent and updated inflationary data, when will we perhaps see the potential pass-through to consumers from tariffs? At this point, it appears to be more mild than had anticipated, and we'll wait to see what that looks like as 2026 unfolds. Disposable personal income growth rates continue to accelerate. A fascinating chart going back to 2001, and as we can see, this is really divided into 3 different categories. On the far left side, from 2001 through 2013, disposable income was growing at an average of about 4% per year. That moved up closer to 4.5% in the middle of the chart, and we've really seen a re-acceleration on the far right side of the chart when it comes to the growth rate of personal income north of 6% at this point. So very fascinating to see more money in folks' pockets, feeling better about their personal situations and having that income available to continue to spend. One other really important note here, there are some new tax tables and withholding tables that are applicable starting January the 1st as a result of the big beautiful bill. Analysts range that may result in, on the low end, up to $50 billion, on the high end up to $150 billion of additional cash that can be kind of put into the market throughout the course of 2026. So another tailwind for consumer spending and ultimately a good trend here when it comes to disposable incomes. The major indices continue to hover near record highs. We went through our blips just before the Thanksgiving holiday. We had a little bit of a blip in December time period as well, but just a lot of resiliency when it comes to the 3 major indices here in the U.S. and good continued momentum for the last handful of months here, close again to that peak. Switching gears, let's talk a little bit about the stock market and ultimately the S&P 500. We know that 2023 and 2024 were really the key years of the Magnificent Seven stocks, those key tech players that were really driving the markets as well as earnings higher. The right side of this chart, with the slight shade in 25 and 2026, ultimately shows that story starting to flip-flop a little bit. Now, the shaded portion of the right side is analyst forecast versus the left-hand side is the actual figures that we have after those years are in the books at this point. The most important factor here is we continue to see the rest of the S&P 500, the other 493 names, really starting to play a substantial catch-up versus the Magnificent Seven companies. That's huge for the broadening out that we've experienced in the markets. It's not just these key 7 players driving stock market performance. It's a much larger swath of the S&P constituents that are ultimately driving the markets here. So a healthier backdrop heading into 2026 from an earnings perspective for all of the S&P 500. How does that translate into revenue per worker? This is an interesting statistic to measure essentially the productivity of firms. Here we have a chart going back essentially 40 years to the 1986 time period, and we have all of these key milestones of really technological innovations that have taken place throughout the years. Obviously, we are living in the big data, AI/automation time period now. We've seen a massive move up in this revenue per worker statistic. What's also of particular interest is we really stagnated for the better part of the last 15 years, kind of right after this cloud services time period in the middle of the chart. So good to see continued productivity, and ultimately that's showing up in some of the key data that we would look from S&P 500 companies. So volatility in the stock market is historically normal every year. Here we have a chart going back to the 1990s for the S&P 500. The darker blue bars are the return at the end of that given year. The lighter blue triangles on the bottom half of the chart is the largest intra-year drawdown, the lowest level that the S&P hit in any given year. As we focus our attention to the right side of the chart for 2025, we see that back in April and Liberation Day, when those tariffs were announced, the S&P had a drawdown of 19%. Now, it did finish the year up, and in fact, it was positive almost 18% last year when you account for dividends within the index. However, looking back, that 19% drawdown, very average and kind of historically normal when we look at the fluctuations that the S&P 500 has in any given year. So a lot of volatility, but average figures when we really sum it all up over the last couple of decades. Let's switch gears. Let's talk about the mortgage and the housing market in particular. We had some pretty big announcements out of the Trump administration announcing $200 billion worth of mortgage bonds that were to be purchased by Freddie Mac and Fannie Mae. That is the primary reason that you see a very large tick down on this chart on the far right side. Now, what we're looking at is the spread of mortgage-backed securities relative to U.S. Treasuries. This is a tightening within that market, and it's ultimately one of the reasons that we've seen the 30-year mortgage rate continue to drop here as well. So fascinating to see a little bit of the decisions from Trump and ultimately these large asset purchases and the impact that they're having within those relative fixed income markets. Now, what is this doing in terms of movement in the housing world, in the mortgage world in particular? We are now at right around 6% on the 30-year mortgage rate. That is sparked a flurry of purchases and refinancing in the last handful of weeks, really offering some hope to the housing market that's been kind of plodding along for the last couple of years. This new 6% or so figure is the lowest since September of 2024. It's also certainly the lowest going back to 2022 before we saw a substantial move in mortgage rates. On the bottom half of the chart, we see the purchase applications index and a nice uptick there on the far right side. Now, this chart does go back to January of 2022, so it's measuring the last handful of years, but nice to see mortgage rates coming down and ultimately more activity in the mortgage world ticking up as well. We see this further exemplified within new home sales. So a nice tick up here in the last couple of months. Data that was out last week showed that the annualized pace of new home sales in October was near the strongest that we've seen since 2023. So we're starting to see some figures that are really illustrating some relief for the housing market that's been a tough backdrop from an affordability perspective for the last handful of years. Finally, on the housing market, a little bit more relief. We're seeing the median new home price of a property down sub $400,000 when we look nationally. And as we can see on the far right side of this chart, really new home prices have continued to fall and are now sitting at multi-year lows versus the large run-up that we saw coming out of the pandemic. So a little bit more relief on the sticker price there when it comes to new homes. Lastly, we're going to end today with a fun one. So for all our pizza lovers out there, pizza is in decline in the US since 2018 on the far right side of the chart. If it feels like there's a new coffee shop and bakery or a new Mexican restaurant in your neighborhood, you're not alone. That's been on the uptrend throughout the last handful of years across America. Probably the most important takeaway here is on the left-hand side. All restaurants have continued to increase over the last couple of years. This really highlights consumers being in a pretty good position, feeling good about eating out of the home as opposed to meals at home, and just good growth overall for the restaurant industry. Key inflation figures ended 2025 on a tame note, and disposable income continues to rise. Consumers appear to be in a fairly good position entering 2026, which is a great backdrop for the output of the country and some of the GDP figures throughout the year. Earnings for the rest of the 493 stocks making up the S&P 500 have started to play catch up to the Magnificent Seven companies, and that gap is expected to close throughout 2026, indicating strong stock market performance, but a broadening stock market as well. And finally, U.S. mortgage rates have dropped to the lowest levels in years, and some of the key metrics for the housing market indicate potentially good news on the horizon for the mortgage world in 2026. Please send questions to info@shjwealthadvisors.com. Thanks for joining me. I'll see you next time.